face-to-face summit seems to be a proven way to focus and synthesis thinking of all stakeholders to accelerate the growth of the industry. Today, investors, wealth managers, family office captains, chartered accountants, legal consultants, investment managers, and industry experts are all available here. I acknowledge the value of your time. Thank you. The climate is all set for discovering the imperatives for change, open up issues, and resolve them, and fostering new or improved relationships. Let us now move into the main agenda. In my opening remarks, I would like to touch upon the following aspects: evolution of financial markets in India, how alternative investments can bring in balance in a client's wealth portfolio, global trends in alternative investments, a suggested framework for wealth management portfolios. So let's start with the evolution of financial markets. All of us here are aware of the benefits that financial assets give us compared to physical assets. Ease of transacting, price discovery mechanism, transparency, counterparty guarantee are some of the benefits I would like to quote here. I wish to recognize and appreciate the regulators, the trading exchanges, and their members for making the radical shift happen in a comprehensive manner. Today, because of this efficient way of transacting and advent of financial assets, effective third-party wealth management has become a reality. I would also like to touch upon the value additions that have happened till date to financial assets in terms of efficiency in picking stocks and building a balanced stock portfolio by the mutual funds and the portfolio managers. This is, of course, depending upon the mandate given to them. The wealth managers have taken these financial assets in equity and debt portfolios to the end clients and have done the hard work over the last couple of decades in laying the platform between the asset managers and clients, paving the way to launch further and other innovative products. But is the job over? Is a question all of us need to ask. The assets or products that are forming a part of the wealth portfolio are predominantly physical assets today, like real estate, gold, etc., and a very less percentage of financial assets. The equity portfolios world over are almost and always positively or so today, if you take the portfolio of large investors, family offices, etc., the assets are products that are forming part of their wealth portfolios are predominantly physical assets like real estate, gold, etc., and a very less percentage of financial assets. The equity portfolios which form a part of the wealth portfolio world over are almost and always positively correlated, and they are particularly correlated when the markets are declining. This makes it difficult for wealth managers to increase the percentage of financial assets in a client's wealth portfolio in spite of the advantages of financial assets vis-a-vis physical assets. As a result of this, wealth portfolios are heavily skewed and concentrated. How do we increase the percentage of financial assets at the same time bring in the required balance in a client's portfolio is a challenge all of us, I'm sure, are confronted with. With the evolution of modern financial markets and growing familiarity of financial assets among the investment community, the platform today has been laid for sophisticated and advanced financial products to be created and delivered to our Indian families through the AIF platforms. Today, with the advent of AIs, the possibility of bringing in more offerings is possible. The advent of AIs has brought few important aspects that can be very critical in providing a balance to the client's portfolio. I shall quote a few here. These alternative investments, when added to a client's wealth portfolio, they provide less correlated offerings such that it reduces the volatility in their portfolio. They provide exposure to more asset classes like commodities, real estate, currency, and their derivatives of various financial assets, thereby enhancing diversification in the client's wealth portfolio. Of course, in our AIF platform, commodities has not yet been allowed, so subject to regulatory approval, this might happen in the future. The alternative investments also provide the possibility of enhancing returns through the use of leverage and other product innovations. They provide the possibility of investing in unlisted space, which can have some good niche companies by bringing in professional management into the unlisted space. I would like to also tell you that 80% of our country's businesses are happening in the unlisted space, and in this sense, AIs can offer a very good exposure into the unlisted space. It provides the possibility of managing market risk through hedging strategies, provides the possibility of reducing directional dependence for generating returns through the use of long-short strategies. Dear panelists, I am sure we will be discussing a more comprehensive list of benefits in our panel discussion. I would like to touch upon the categories that are used in the Indian AIF regulation. So from an Indian AIF platform point of view, the important categories through which the above benefits can be achieved are PE funds, real estate funds, hedge funds, VC funds, etc. In the slide, I have just categorized these in the form of Cat 1, Cat 2, Cat 3 as they have been done by the regulator. Now let's move on into the global trends section as to how investments are happening globally in the alternative investment space. This data has been taken from Tower Watson. If you see the survey, I have given two slides here. So I have included here one from the perspective of top 100 funds in terms of the assets managed, and another one from the point of view of the total AI universe. In the first slide, you can see that real estate funds have a share of almost 33%, while PE funds, hedge funds constitute around 23% each. It also shows that pension funds are one of the top investors in the alternative investment space, clearly showing that serious money is being invested in the alternative investment space. If you see in the total universe slide, total AI universe slide, huge hedge funds are having a share of around 27% of the total asset under management, while real estate and PE have 23 and 20% respectively. The overall AUM is around $6.3 trillion. This suggests how this space is progressing globally. A further study into the survey also tells us about the latest way by which the various funds are validated by institutions. In the Indian scenario, we can see that around 25,000 crores have been raised by way of commitment, of which the bulk of investments are in the category 2 space. The trend clearly shows that compared to the global scenario, Indian markets have a long way to go. And all of us, I'm sure, are happy and excited about becoming a part of this growth. While the benefits of alternative investments and global trends are really exciting, we should also know the trade-offs that an investor might have to forego while investing in an AI. I'm just listing out a few for you. So when an investor gets into an alternative investment space, there is a possibility in the respective product or in the respective fund, there might be some reduced liquidity which might happen. The increase of risk of loss of capital also might happen. there is a possibility of loss of the advantages that exchange traded assets have in terms of the transparency, liquidity and all, as I mentioned in the first slide, at the level of assets that are being used within the fund. While enhancing risk management, like when I said we'll be using these hedge funds for managing market risk through hedge strategies, there is a possibility of underperforming the actual underlying asset. There are certain tax issues which are confronted to our AIF structures, and there are certain other issues which I feel will be completed and will be brought forward in a more comprehensive manner by our panelist team. So from this, what we'd like to tell you is there should be a way how do we evaluate these funds which are existing in the alternative investment space. My dear audience, keeping the above benefits and trade-offs in mind, it will be great if the panelists can suggest methodologies using which different funds, products in the AIF space can be evaluated. As I mentioned earlier, some of this has been captured in the Global Trend Survey by Towers Watson. We should keep in mind that returns are only one aspect of the overall evaluation process. Now let us move into the last section of the opening remarks, wherein we will talk about how to view and manage a wealth portfolio with the advent of alternative investments. Dear audience, today, considering the current investment scenario, things have really changed, and they've changed for good. Even though a lot of complexity might exist, we would like to understand how things have changed. Similar assets are being obtained by different investors with different objectives. Multiple asset classes have been integrated into a single platform, and the same asset has been strategized differently, thereby altering the risk and characteristics of the underlying asset. So are the days gone when the investors take their investment decisions solely based on the weightage given to an asset in their wealth portfolio. Going forward, is risk allocation a better way of allocating investments and viewing wealth portfolios? So how do we go about using this risk allocation framework is what we are going to see. In this framework, you can see that it has been clearly shown the investments are segregated into three buckets based on the objective of the investor in terms of returns and the willingness to take risk. The source of the framework is mentioned at the bottom of the slide. In the first bucket, the investor wants to minimize the downside risk. Safety of capital is his objective, for which he is willing to accept below market returns. In the second bucket, investors want to increase the probability of maintaining their current lifestyle, and wherein he is willing to take commensurate market-related risk for achieving this objective. In the third bucket, the objective of the investor is to take higher risk and achieve certain aspirational goals of life. It would be really helpful if our panelists can explain the risk associated with the assets they are talking about or the funds they are talking about, and suggest from a risk allocation point of view how their products or categories should be viewed. The framework attempts to find an optimal wealth management strategy that minimizes the probability of achieving a clearly defined set of goals. This requires a careful risk allocation, that is, balance between safety, market risk, and, if desired, aspirational investing. A process that focuses on achieving client's goal rather than simply beating the market, which may provide a reasonable guide to investing for an otherwise uncertain future. The asset types and the purpose it serves in the portfolio determines the placement of each asset into one of these three different risk buckets. Hedge funds are placed in aspirational buckets because of the risk associated with any single hedge fund, regardless of their investment strategy. Again, these are not conclusive things. These are debatable, and I'm sure a lot of things will be brought out from our panel discussion. Again, when we take a properly diversified portfolio of hedge funds, they could have been placed in a market bucket, in the market bucket. Cash, which is being held for personal safety, is treated as a protective asset, whereas cash held as reserve for investment purpose is treated as market asset. Similarly, a real estate asset held for living purpose is placed in the protective asset. However, based on the concentration or the geographical location of the real estate, the same may be classified as a market asset or an aspirational asset as well. I encourage you all to go through this framework in detail. I am sure you will appreciate the concept in managing your wealth. Dear audience, I would like to summarize the opening remarks in the following manner. We understood the significance of financial assets as an appropriate means for managing third-party wealth. We have discussed the aspects of alternative investments that brought in the required balance in a client's wealth portfolio and in the process increase the percentage of financial assets. The benefits and trade-offs in general have been spelled out, and of course a more comprehensive list will be coming out from our panel discussion. We have witnessed global trends in AI and the corresponding Indian scenario, which showed us a great gap, hence a huge potential, and we are all excited about it. In this changing scenario of asset classes and characteristic of assets changing with the advent of alternative investment, is risk allocation framework a better way of managing clients' wealth portfolio instead of a conventional way of asset allocation framework? Dear audience, I'm not taking away too much of your time, and we would like to spend a lot of time on the panel discussions and other subjects about taxation related issues. With this introductory remarks, I would like to conclude that with all the experienced professionals and great thinkers present over here, today will be an enriching day for all of us. I would also like to express my gratitude to the source from where I have taken certain information for making this presentation. Thank you.